I think we're ready. Welcome back. I appreciate you spending a little time with me here today on this video. Now, there's a couple of things you could be watching, a couple of reasons you could be watching me. You could be watching me because of a course that you purchased from my system designed to teach you about the stock market, or you could be watching a video that I create, this video that I created and I upload to my YouTube channel and the other places that I post. But hopefully you're watching for the course purposes, because this course is very important when it comes to understanding the stock market. Not only that, but this course also helps you to figure out how you should create your online presence, or what I like to call your online business. Because once you create an online presence, then you have an opportunity to market products to an audience that you're creating, right? Like initially, you won't have an audience, zero, right? And that's cool. That's not a problem. What will happen is once you start to create videos and post those videos where people can access those, then people will begin to gravitate to it. They'll begin to like it, they'll begin to share it, and they'll begin to participate in other content that you begin to create, right? Now, that is a process, but there's a beginning to it. And that beginning is you making the decision that you want to, start your own online business. And that's in the 21st century, that's one of the better things you want to do, because it can all be done from the comfort of your own home, just like I do. Now, I do other things as well, but this product creation that I'm doing right now is specifically designed in line to help you learn about the stock market, and two, understand that you can create your own business. Don't let people tell you you can't do that, because technology has advanced to the point where you can do that and it's not difficult. But having said that, I really appreciate you investing in you if you're watching this from a course that I created. Because I want you to see my shirt. This is Texas. That's why I'm in Texas. I don't know where you are, but I'm in Texas right now. And I create videos on Tuesdays and Thursdays. That's how my system is set up. Now, you can set up yours where you create videos on Mondays and Wednesdays, or Monday, Tuesday, and Wednesday, or however many days a week you want to do it. But you have to remember that you're sharing information that you've learned through your research process to help people understand and gain a perspective on a certain topic or a certain subject. Not difficult. Actually, the subject is something that you already like, or something that you already love or have a passion for, or something that you're like me with this course that I'm willing and interested in learning about, right? So believe me, before I began this video series, I knew very little about the stock market. Now I know a lot more about the stock market. Not a lot, but this is going into month number 2. You can't learn everything you need to know in 2 months, but it's a good start. And by the time I get to 90 days, I'll have created 4 products, 3 individual products and 1 collectively. And I'll be generating a profit from each of those, right? And that's forever, as long as I want to run those. And that's what you want to do too. Then you just hire a marketing company to market those links, to different places. Now, people that are interested in that particular thing, money in the bank, right? That's what you want. So having said that, I'm going to begin, because today's topic is going to be called primary and secondary markets. Now, the first month of videos that I created was basically terms and definitions, right? This is month number 2. This is actually the last video of month number 2. I think I may make like an additional bonus video to go along with it. But after I finish this video, then I'll transfer this information to my online course system, which is called teachables.com. I'll just transfer the text and the videos, and then I'll put in the information, the photos and video, the photos and, logos and things like that, and price points, things like that. Not difficult at all. And that will then become another course. There'll be 2 courses that I've created that will be generating profit. That's it. I'm doing nothing else. Just sharing what I've learned. That's exactly the way you can do the same thing. But this part right here, this again, it will be the last video for my second online course. But going in, including this video and the next one, is going to be really technical when it comes to your understanding of how things go in the online stock market world, right? So buckle up, and we're going to take a little ride here. I really hope you enjoy this because I really enjoyed creating it. So it's, again, primary and secondary markets, but I'm going to talk about other things too. Now, the word market can have many different meanings, but it is used most often as a catch-all term to denote both the primary market and the secondary market. In fact, primary market and secondary market are both distinctive terms. The primary market refers to the market where securities are created, while the secondary market is one in which they are traded among investors. Knowing how the primary and secondary markets work is key to understanding how stocks, bonds, and other securities trade. Without them, the capital markets would be much harder to navigate and much less profitable. So I'll help you understand how these markets work and how they relate to individual investors. So let's go with the primary market first. The primary market is where securities are created. The primary market is where securities are created. It's in this market that firms sell new stocks and bonds to the public for the first time. An initial public offering, or IPO, is an example of a primary market. These trades provide an opportunity for investors to buy securities from the bank that did the initial underwriting for a particular stock. And an IPO occurs when a private company issues stock to the public for the first time. For example, company ABC Inc. hires 5 underwriting firms to determine the financial details of its IPO. The underwriters detail that the issue price of the stock will be $15. Investors can then buy the IPO at this price directly from the issuing company. This is the first opportunity that investors have to contribute capital to a company through the purchase of its stocks. And a company's equity capital is comprised of the funds generated by the sale of the stock on the primary market. A rights offering issue permits companies to raise additional equity through the primary markets after already having securities entered the secondary market. And current investors are offered prorated rights based on the shares they currently own, and others can invest in newly minted shares. Other types of primary market offerings for stocks include private placement and preferential allotment. Private placement allows companies to sell directly to more significant investors, such as hedge funds and banks, without making shares publicly available. While preferential allotment offers shares to select investors, usually hedge funds, banks, and mutual funds, at a special price not available to the general public. Similarly, businesses and governments that want to generate debt capital can choose to issue new short and long-term bonds on the primary markets. And new bonds are issued with coupon rates that correspond to the current interest rates at the time of issuance, which may be higher or lower than pre-existing bonds. The important thing to understand about the primary market is that securities are purchased directly from an issuer. Okay, you got that? Now I know that's a lot to digest and that's a mouthful, but if you just, go back over these notes or this information, then you'll be able to process it, because that's what I had to do as I was reading it for the first time. I had to understand it for myself, because remember, I'm new to this. I knew very little about it anyway, either. So it all adds up and helps me as I help you. Now, the secondary market that's for buying equities. The secondary market is commonly referred to as the stock market. This includes the New York Stock Exchange, NASDAQ, and all major exchanges around the world. The defining characteristics of the secondary market is that investors trade among themselves. Listen to what I just said. The defining characteristic of the secondary market is that investors trade among themselves. That is, in the secondary market, investors trade previously issued securities without the issuing company's involvement. For example, if you go to buy Amazon, let's say you go buy Amazon stock, you are dealing only with another investor who owns shares in Amazon. Follow that again. If you go to buy Amazon stock, you are dealing only with another investor who owns shares in Amazon. Amazon is not directly involved in the transaction. In the debt markets, while a bond is guaranteed to pay its owners the full par value at maturity, this date is often many years down the road. Instead, bondholders can sell bonds on the secondary market for a tidy profit if interest rates have decreased since the issuance of their bond, making it more valuable to their investors due to its relatively higher coupon rate. And the secondary market can be further broken down into two specialized categories. Auction market is one, and the other is dealer market. Now, in the auction market, all individuals and institutions that want to trade securities congregate in one area and announce the prices at which they are willing to buy and sell. These are referred to as bid and ask prices. The idea is that an efficient market should prevail by bringing together all parties and having them publicly declare their prices. Thus, theoretically, the best price of a good need not be sought out, because the convergence of buyers and sellers will cause mutually agreeable prices to emerge. The best example of an auction market is the New York Stock Exchange. Now, a dealer market, in contrast, a dealer market does not require parties to converge in a central location. Rather, participants in the market are joined through electronic networks. The dealers hold an inventory of security, then stand ready to buy or sell with market participants. These dealers can earn profits through the spread between the prices at which they buy and sell securities. An example of dealer market is the NASDAQ, in which the dealers, who are known as market makers, provide firm bid and ask prices at which they are willing to buy and sell a security. The theory is that competition between dealers will provide the best possible price for investors. Okay? Now, a fast fact. This is a fast fact. I want you to pay attention to this. The so-called third and fourth markets relate to dealers between broker-dealers and institutions through over-the-counter electronic networks, and are therefore not as relevant to individual investors. So your question may be, what are third and fourth? Third and fourth markets, right? Well, glad you asked. Here we go. Third and fourth market. You might also hear the term third and fourth markets. These don't concern individual investors because they involve significant volumes of shares to be transacted per trade. These markets deal with transactions between broker, dealers, and large institutions through over-the-counter electronic networks. The third market comprises OTC transactions between broker-dealers and large institutions. The fourth market is made up of transactions that take place between large institutions. The main reason these third and fourth transactions occur is to avoid placing these orders through the main exchange, which could greatly affect the price of the security. Because access to the third and fourth markets is limited, their activities have little effect on the average investor. And the bottom line is that although all the activities that take place in the markets that I've discussed affect individual investors, it's good to have a general understanding of the market's structure. The way in which securities are brought to the market and traded on various exchanges is central to the market's function. Just imagine if organized secondary markets did not exist. You'd have to personally track down other investors just to buy or sell a stock, which would not be an easy task. And in fact, many investment scams involve or revolve around securities that have no secondary market because unsuspecting investors can be swindled into buying them. The importance of markets and the ability to sell a security, liquidity is often taken for granted. But without a market, investors have few options and can get stuck with big losses. Now, when it comes to the markets, therefore, what you don't know can hurt you. And in the long run, a little education might just save you some money. Got it? Now, I told you that this will be the last video for this second course. And you can tell that things are getting a little bit more intense, right? So you with the first set of videos, you've understood terms, definitions, and second, in the beginning, you understood some strategies and techniques. Now we're going to go into a little bit more about the nuts and bolts of everything, right? So I hope you're prepared. And I really do appreciate you stopping by and taking the time out of your schedule to invest in you. Again, my name is Larry James. My company is Speak with Larry. And as always, share with someone else what I've shared with you.